the trump cards. We'll move on to the next topic of the day. We have got Mr. Trideep Bhattacharya, CEO Equities Edelweiss, to give a small briefing about him. He has completed his PGDBM in Finance from SP Jain Institute of Management and Research, Mumbai, and also he is a BTech in Electrical Engineering from IIT Kharagpur, and he got 2 decades of experience in equity investing across India and global market. Before joining Edelweiss AMC, he was instrumental in building a market-leading PMS business at Axis Mutual Fund. May I call upon Mr. Trideep? Yeah.
Good evening, everyone. Good evening. Like the previous speaker, I can't speak in Tamil, but I would say this: Na urdura sonna, na nudura sonna mari. So, I have a job to do. I have precisely half an hour. When that, I have to communicate my point, and I don't know if you allow Q&A. I hope to have 5 minutes of Q&A. So I'll go at a certain pace, and I want your attention, which is why I said what I had to say. So I think the global problems was well described by my previous presenter. I will come from a market standpoint as to how do we think about equity markets, not just in India, but globally. I have a few slides. Hopefully that explains my case. The first point that I would say is that we are moving from a meaningful uncertainty globally to macro certainty. Summing this up, we have seen a rally of close to 18 to 22% in United States and almost about 13 to 14% in India. Okay? So if you have been sitting in cash, you've missed it. And that's the reason why across our portfolio, we've held very little cash. We captured a good part of it. But the moot point is to understand what is really happening. Okay? So drawing a datum level from beginning of the year, I would say at start of the year, there were 3 major uncertainties. First, we didn't know how we will spend. We as in India will spend. Okay? That got clarified on the budget session when Honorable Finance Minister Nirmala Sitharaman talked about India's spending plans. Okay? We, beginning of the year, didn't know Trump's spending plans. Now, at least we broadly know which direction he is headed. The third uncertainty was, beginning of the year, that actually, previous 9 months, there was no economic decision making. All the politicians were looking to get themselves elected. And hence, earnings estimates were completely off. Okay? If I were to give you an example, at the end of December quarter numbers, we started off projecting FY25 for 15% growth. We cut close to about 10 to 12% earnings cut that happened in a year. Okay? This is a big earnings cut. So we were on an earnings growth trajectory, earnings upgrade trajectory, but that got spoiled in FY25, which almost led to a year of no growth. That was the third uncertainty that we had. If you took a snapshot today, we know what our spending plans are, we know what Trump's spending plans are, and we know that economic decision making in the country has started. You look at the defense order announcements, you look at infrastructure order announcements, and it's very easy to see through that. The only thing that we don't have going in our favor are, anybody? Earnings. Even at the end of the Q4 numbers, if you look at the downgrades to upgrades, which is what we monitor as a fund house, there are 4 times more downgrades than there have been upgrades. So earnings is something that we have not come back. But the lead indicator to earnings, which is decision making, government decision making, that has started to happen. So overall, we think that from the start of the year, where we see in the markets today is a relief rally on account of macro uncertainty. The micro part, which is the earnings, is still kind of, yet to happen. And our hypothesis on earnings is that we would see earnings starting to come back in second half of fiscal year 26. Okay? And that would be driven by three themes that we have highlighted here, themes of 2026. The first I would highlight is the consumption recovery. While all of us have been debating when the next drone is going to come through in the last few weeks, and before that, which country will Trump, bombard next with his trade as a weapon, 3 or 4 things happened which are very beneficial to India. First of all, crude oil prices fell 25% plus. Last time when this happened, we saw a consumption boom. Okay? Second, inflation came down, you might have seen the recent data, by almost 100 basis points. And third, rate cuts of almost 150 basis points have happened, and by the time we get to the end of the year, some more to come through, along with financial easing. So financial conditions have eased meaningfully. In many ways, as we go towards the back half of this year, we will see many catalysts line up quite well for consumption. The last one being what our Honorable Finance Minister gave us, which effectively meant a 2 to 7% salary increase for the middle-income investor, middle-income urban consumer. So we think that consumption as an area is something that is expected to do well towards the back half of fiscal year 26 and thereon. That's one of the themes that we are certainly kind of overweight in our portfolios, and we think there is more to go. The second is resuming government spending. For better part of calendar year 24, we had no government spending that actually came through. Okay, you might have heard the data that they had budgeted for 11 trillion rupees, 11 trillion of this, they fell short by close to about 15 to 20%. Well, the good news is that if you look at the defense ordering and the infrastructure ordering that have started from the calendar year, we are well on our track to point out that there is government spending which is resuming. The difference is, this time it is a little more strategic. It is focused on more specific areas like defense, power, railways, where earlier it was very broad-based. So we think resuming government spending and its impact on earnings is something that is an area to keep an eye on. We think that as an area we'll see strong earnings growth going forward. The third is basically the flow show. So if you look at, let's say, the flow picture, then what you will see here is that, in FY25, we saw a good amount of FII outflow, close to about 16 billion. We have seen a rebound in FII inflows. Why is that happening? Why did it change? In my opinion, it changed the day dollar changed the course. If you look at the chart on the top, it shows that dollar was continuously appreciating overall, where finally it started to come down round about beginning of this year. Okay? And that is where basically, the FIIs who have been earlier fairly negative on India, as the dollar turned, their flow towards India has also changed. And my sense is, over the next 3-5 years, the economies which are more oriented towards domestic earnings are the ones which will see more inflows coming through as opposed to economies and countries exposed to exports. Why do I say so? If you look at the end game of tariffs, from where we started, where global trade was free and flowing, one thing is very clear. Whether it is 10%, 40% or 140%, we all are moving towards basically a nationalistic world where everybody has to start up owning their own country, producing in their own country, and that has to be the source of their own earnings. India, in that context, stacks up very well versus that of competitors. If you look at our GDP, only 16% of that is exports. The rest is kind of geared to the domestic economy. And hence, when FIIs look to allocate money outside of United States, India becomes one of the favorite areas, because overall, with regards to kind of, domestic centricity of earnings, we score very well. This is not true for Korea or Taiwan, where a significant part of their earnings is levered to United States, or even for that matter, China. China has other things going for them. But if you look at amongst all the EMs, India as a domestic heavy economy stands to benefit significantly. Hence, my point that overall, so flow picture, in my opinion, would be in favor of India as we move towards calendar year, as we move through the year overall. That brings me to the next point, which I wanted to highlight, the valuation and the earnings picture. Now, I have to say that this is a data collated as of yesterday. While in the medium term, we are all positive, I must say that if you look at the chart on the top, we are very close to, in terms of valuations, the September highs. This is a near-term problem. Okay? As we have gone through from macro uncertainty to macro certainty, one thing is that it has been quickly lapped up by the markets, even though earnings have not come through. Right? How do we see that? If you see on the bottom, the last time we saw earnings upgrade was in FY24. After that, if you look at FY25 and FY26 earnings, which are the purple and the red curves, it has coming down. This is the crux of what we are dealing with today. And that's why I was giving you that the good news is only good news in parts. The good news is we are insulated in a good way because we are domestic earnings driven. The good news is that the overall macro uncertainty is out of the way. But what we have not been able to notch up is basically our earnings story. This is what we need to get through if we want to get through beyond our, the previous peak from an earnings standpoint. So, given that valuations are close to peak, even though we have many things going, our outlook from a market standpoint is that we would expect a sideways market in the near term. We think a better part of the near-term gains after about 14% that we have seen from the bottom, or even kind of otherwise, captures a good bit of macro positive already. For us to march on forwards, we will need to have earnings come back, which we talked about in second half of fiscal year 26. And as that stands to happen, then we will scale new heights. So maybe a bit of a breather after the rally that we see. The next flashpoint in the context of our markets would be end of June, early July, when the first 90-day window opens up. My sense is there could be some more posturing that you might see from United States as they try to negotiate the best deal forward for their own consumers and kind of best deal forward from different kind of, different economies overall. So, some bit of macro picture, tantrum is still remaining. Brace up for that. We think we have seen a good bit of rally already and some bit to follow through. So how are our portfolios positioned? For people who have dealt with us as Edelweiss would know that our portfolios are usually bottom-up portfolios. We don't take a very kind of inflation-oriented, macro-oriented view and then design portfolios. We go bottom-up, trying to understand where earnings are likely to be resilient on a relative basis and place a good bit of our portfolios in and around that. So these are the 4 areas that ultimately our portfolios are positioned towards. Okay? I'll start with consumption. We are overweight consumption, particularly from a discretionary standpoint in our portfolios, as we think that falling oil prices, lower inflation, interest rate cuts, and easing financial conditions will create conditions good enough for consumption to start to pick up as we get to the back half of this year. Defense is something that we have been positive for a good while. We continue to remain positive from a medium-term standpoint. We think though near-term the stocks have rallied a good while, but from 3 to 5 year perspective, as India starts to make its presence felt in the geopolitical landscape, this component of India's spending will be structurally up, if you ask me, over the next 3-5 years. And I'm sure after you have seen the drone warfare over the last fortnight, you would agree with me that some part of this is actually needed. And for the first time, India's defense equipment got tested successfully in war conditions. So you will see a good amount of their budget coming through. We are very well positioned in there. Third is NBFCs. By that I mean asset financiers, CV financiers and whatnot. Some of the companies are well-known companies from the south, but basically these are the companies where we have reasonable valuations, and at the same time, overall, when rate cuts tend to happen, their earnings get a natural positive kicker. So we think that that is the third area where we are overweight in our portfolios. It has worked out well, but there is more to go because overall earnings growth versus that of valuations is still in place. Finally, IT services. This is a contra call. We have been negative getting into this result season, and we have highlighted that this is more tactical in nature. We think this is the worst possible time of IT services. With Trump throwing tantrums, no visibility whatsoever globally, this is the worst possible time that can happen for IT services. So whatever valuations you get, that's the best you can get to. This does not mean that earnings will rebound tomorrow, but macro conditions from IT services perspective will start to improve. How? In about 6 to 9 months' time, once we go through this taper tantrums, Trump will get on to the tax cuts in the United States. As the tax cuts tends to happen in various different shape or form, we think that one of the sectors that very directly and strongly benefits from such a scenario is IT services. Because overall their health improves, and as a derivative on that, IT services tend to improve. So we have been underweight since the beginning of this year. We are gradually turning neutral to overweight in this space. Net, these are the areas that we are positive on from our portfolio positioning standpoint, mostly driven by earnings resilience. Finally, as we come to the final part of my presentation, I would like to leave some thoughts with you, which are real long-term issues from a market standpoint. These are the issues which you deal with when you think about portfolio allocation to your clients, may not be relevant immediately. First is from deflation to inflation. Whether you like it or not, ladies and gentlemen, you have to realize that gone are the days when everything was manufactured in China and sold in the United States. If I were to very briefly ask you a question to everyone, can you tell me over the last 70 years, how has the price of a washing machine in the United States behaved? Up, down, and by how much? Anybody? I'm on a tight leash on time, quickly. Up, down, same. Folks, it is down 50%. And the reason why it has been down is because majority of the production went to China. Well, the bad news is that is about to reverse, if not already. Now, what you are seeing in the case of washing machine in the United States, the same thing is happening in different goods and services across different countries. We have a make in India, US has a made in US, Europe has a made in Europe, everybody has make in their own country. When that happens, ladies and gentlemen, there is only one outcome, which is we are going inflationary. So structurally, we would be in higher inflation stage no matter which way you cut it. So from an asset allocation standpoint, as all of you sit with your clients to allocate which are the right assets to be in, there are two which in my opinion you should hold more than what you held before. One is equities, because when things are going fine, equities are the best known inflation hedge. And the second is gold. And it's not that today I am saying this, we have been saying this for a good while, we still think so, that when things are going pear-shaped, gold is the best hedge that you can think about from a asset allocation standpoint. So some pointers to all of you to think about. Second, now when I wrote this early signs of balance of power realignment, April didn't happen. But if you look at Trump came out guns blazing with 140% tariff on China. Then there came 2nd of April, and then he flipped in one weekend from 145 to 40. What happened? Well, what happened is bond yields, instead of going down, started going up, which means very quickly the markets were telling them that US is no longer the only leader in the world. The unipolar leadership that we have been dealing with for the last 50, 70 years is changing, ladies and gentlemen. That does not mean that tomorrow all of a sudden, China becomes the hub. But over the next 10, 15, 20 years, you will see this transition starting to happen. And as that happens, you will see multitude of bilateral agreements standing to happen, which means the strength of US dollar will actually gradually come to question. And likewise, the dominance of one size, everything, all the business going to United States will also something which people will wonder about. So the point is, the balance of power realignment is moving more eastward. And this, if not obvious, there are many signs. For example, when DeepSeek happened, the world realized for the first time that it is not only US which is the hotbed of innovation. Innovation has also shifted eastwards. Okay? After the war that we went through with, with Pakistan, the world will know that India today is also a sizable defense power. So the power alignment is changing. So when you think about allocating US funds or global allocation towards global funds, you've got to bring this thinking in that in a multipolar world, how would you go about investing? That's the thought second thought I want to leave with. The third is polarization of profit pools. Now, in India, this is a point with regards to India. And if you think about it, paints, cement, cables and wires. Can anyone spot what is common amongst all of them? Huh? Competition. So, all of a sudden, these three areas have seen an onslaught of competition. In paints, it was a very high profit pool, high gross margin, high margin profit pool. And you have all of a sudden, new players in the form of Indigo and various different companies, JSW coming in and saying that we also want a piece of the pie. Okay? Same happened in, the cables and wires, where Ultratech said that we want to participate in that game too. So basically what it shows is, today getting capital from private equity and entering into new profit pools is far easier than what it was. High profit margin areas are very quickly getting commoditized if there is no moat. What are the implications for us? I'm sort of cutting short a lot of points in the interest of time. What are the implications for us? The implications for us are some of the stocks which you found historically safe, the large caps, are facing some of the structural changes that they have to battle with. And the disruptors come from mid and small caps. So don't think about mid and small caps as the also-rans or the second rung of companies. They could be leaders too. And if you look at the last round of earnings cut where happened, minimum amount of earnings cut happened in mid caps. The largest amount of earnings cut happened in large and small caps. It should be a wake-up call for all of you when you think about asset allocation across different caps. Should we change the color of the cap is the question. And finally, I would say from promoters to secondary market investors, this is where India is evolving. We have historically a market where people were thinking, the companies to be their own babies, to a Western world where it is more professionally run. As you see more and more promoters coming to offload their stake to becoming a more market-oriented economy, your space of companies to invest in, or our space to companies to invest in, will actually go meaningfully up. And that is basically securitization of markets. This is something that happened in the West about 40, 50 years ago. It's an extremely positive development in the context of markets, and we think that it's a good way to allocate money. I would finally allocate my last 2 minutes to the funds that we think are the first amongst equals amongst various funds that we talk about. So we passionately manage all the simple oriented funds like, for example, tax saver, large and mid cap, flexi, multi and whatnot. Of this, I would leave you with three options which you should think about when you think about allocation. Our thinking, articulating the entire market view into the funds to invest in, is that one should avoid the two extremes, the large cap and the small caps. The large cap have a ton of valuation support, but growth is on the lower side. Small cap have phenomenal growth, but they are very prone to earnings cut and valuations are particularly at this moment very high. So this, and hence our suggestion is to stay in the middle. And when we talk about staying in the middle, we have three funds to offer which we think are, in our opinion, versus competition top class. Rest I leave it to you. First, for conservative investor, I would talk about the flexi cap fund. It's kind of there in the top. This is a fund which is run conservatively. About 55 to 70% large cap, 30% mid and small cap. For investors who come from a conservative mindset, who have historically allocated to more either passive or more conservative outlook and generally get worried about market falls, this is a good place to be. At least 30% of the portfolio is oriented towards when market takes off vertically. At least some part of gain is better captured. Second is for the confused investor, which, trust me, most of your clients are. Some realize, some don't. For them, I would talk about the multi-cap fund. It is struck right in the middle, 50 large cap, 50 mid and small cap. Basically, it captures the better part of the rally overall, for the portfolios and very, very well straddled across the same. And third and finally, I would talk about our mid-cap fund for investors with 5 to 10 year horizon who can take a bit of volatility on their books. This is by far the best category to be in our opinion. And I think relative to competition, we've done historically a good job, but that judgment, I leave it to you. The reason I like mid-cap as a category is, remember when I talked about disruption across different parts of the profit pools, this is one segment which has the growth within India as a growth economy. Okay? Just as an example, if you look at basically, three high growth areas within India, today, at the top of a hat, I would say they are hotels, hospitals, and capital markets. These three segments are growing anywhere between 20 to 30%. What is the representation in the large cap index? 0. So, by investing in mid caps as a category, you are overall exposed to some of the growth parts of the economy where we are. The risk here is not to be mindful of valuations. So this is what we do at our house, that we carefully calibrate the growth versus that of valuations in such a way that we are struck right in the middle. If you look at the PEG ratio of our portfolios, it will be somewhere between 1.1 to 1.2, which means while yes, the valuations may be on the higher side, but growth is also equally at a premium and by and large have held through. So that brings me to end of my presentation with the call to action on three funds depending on your risk appetite. Flexi cap fund for low risk investors, for medium risk investors, the multi-cap fund, and for investors who can take a bit of a downdraft, the mid-cap fund, to stay in the middle rather than trying to kind of really play too safe or too aggressive, with the near-term market call being that we'll probably be in a bit of a time correction over the next 3-4 months before we see earnings kick in the second half of fiscal year 26, when we hopefully turn more positive on. So that brings me to the end of what I had to say. We have 3 more minutes for any Q&A that you may have at this point in time. No questions? Yeah. The bond yield going up, right? it's basically a danger signal more than positive signal, which is partly what I'm saying, that if you look at near-term valuations, the valuations of we are nearing September highs. It's time to be a little more careful than what we were before. Globally and also in India. 6 is actually a dangerous mark in the United States. Bond yield going above 6 means a dangerous signal for US equities and generally globally as well. So hence I said that if you look at very near term, we think we are dealing with a fair value markets. We've got to be careful with our allocations at this point in time. Yeah. That's yeah. Yeah. So overall, I think that is it's a fund run on a more on a quantitative basis, not as per the principles that we described in here, which is why I didn't have it in the presentation. It's managed by a different team within Edelweiss. But while the speaker is not here, what I can say is that it's a bit of a style issue which the fund has been facing with that momentum style not being in favor. And hopefully that comes back over a period of time. But you should get in touch with our sales guy who can put you in touch with the person who can delve a little more on detail on that side. Yeah. Yeah. Near term, when the interest rates go down, there could be a near-term trigger where these funds could give you supernormal returns. But that's more tactical in nature. If you look at overall from a 3 to 5 year perspective, I would again say that yes, while debt or these funds do have a place in the portfolio, one should reconsider and think about allocation towards 2 asset classes, equities and gold, more than what it was before. So tactically positive, long term, we need to think about. Great. Thank you very much for your time.